it shouldn't be surprising if we could throw the platform up to see these commodity currencies like New Zealand dollar and Australian dollar that we'll get to in a second get absolutely annihilated because they're some of the most risk-on currencies out there. They're tied to gold. They're tied to equities around more of an Asian and obviously Australasian kind of equity mix. But still, obviously, yesterday, if SPOs are down 3%, equities across the globe are getting hit. So probably made sense that these commodity currencies got wrecked yesterday. But I mean, to see at certain points this Kiwi down 1.5%, this Aussie down 1.5% yesterday at these lows, that's a huge intraday move. They got right down here and touched 62 cents in the Australian dollar. That's lows for the last year. Let's take the weekly chart out for a spin. We are right there, man, for lows going all the way back to the pandemic crash and then bounce back. They're bouncing it a little bit here today, up 0.5%, but still trading 62 handle.
Right. So from your standpoint as a trader, what do you need to see to, again, bouncing off the lows, U.S. equities bouncing a little bit off their lows, a little bit of, it started last night a little bit, not much, a little bit more being put into it today. What do you need to see throughout the bulk of the day to say, we all know they're cheap. They were cheap yesterday before they broke another 150 points, 150 pips.
Well, yeah, they were down going into the, I mean, 63 was cheap going into the number.
It was so funny. Right before, too, they took Euro down to like 104.80. So it's like 105 is absolutely no concern to anybody. What do you need to see from tape action? Now, this was one we talked about. Okay, what's the scalping range yesterday? It was about, scalping range was about 45, 50 points, one standard deviation. I said for euros, I'm going to add on at least 1.5 times that, so 75 points. If you had done that and bought the 104 evens,
still too tight.
You would have been out of them.
Yeah.
and this is a good example. So just to hold rubber, to hold a little bit of accountability. So you would have bought the 104s. They continue to pound this. This is why I talk about you've got to set some management activity, because when they got to 103.80 and 75, now that was the low. It felt really uncomfortable.
Sure.
So what you've done is set the expectations. Now, it doesn't mean you can't get back in at a different level or wait to see the market settle. But these are the mechanics of, here is one where you got no bounce.
Yeah.
If you were early and impatient,
No.
you really had a hard time. But if you set those scalping ranges, you got to them. You got to them in Aussie, and you would have gotten squeezed out of that too, if you had managed it.
Sure.
But this is how you set up. Now, sometimes they'll hold the levels, and you'll get a nice trade. You walk away from it, and you look and reevaluate. So, but from today's tape action, we're getting a slow grind up. We're not halfway back. And I only mention that as a metric, not from a technical standpoint.
But if you bought the 104s, you could scratch them. Like if you bought the one standard deviation move yesterday and held through all the heat of yesterday late afternoon,
right,
you're probably back to around a scratch. Maybe if you had enough powder, you could buy some at around the one standard deviation move. And it doesn't always happen, I should say, because this always goes one of two ways. The number comes out, you see a big move, you see a couple of minutes of like, okay, is this where we're going to stop? Right. And kind of
guys doing exactly what we're talking about.
Exactly.
All right. They shook the tree pretty hard. I'm going to see if I can get something cheap.
And then they just released.
Right.
And at that point, yeah, it's hard. Yesterday was a tough day to be a contrarian day trader.
Right.
But what I will say in situations like this, if you are day trading and that's the thing, and you're saying, hey, I'm buying and selling the one standard deviation for a contrarian trader, or I'm a trend follower. Obviously, yesterday was great for a trend following trade. Or I'm buying or selling the one standard deviation on the trend basis, and I'm not taking these things past the U.S. equity close. That's when I call it a day. Or I'm not taking them past the way that you trade. If I'm trading a one standard deviation move, then I'll take a quarter of a standard deviation as my scalping range around where I get in for loss or for profit. Yesterday is a really tough one. Now, if you have a little bit of a diversity of strategy whereby you are trying to scalp around a big number like that, but you're also looking at price extremes and you're like, okay, I'll swing trade for a couple of days. You were able to get a nice bounce in here. So hopefully, and maybe just a little bit of, your experience with numbers like this. Of course, you're probably getting in around here and maybe taking some losses, or you're getting in here on the trend basis and you're taking some profits here. But is there any capability in your mind, knowing that we're already at, let me go back to the daily chart, a historic price extreme right here in that 105 to 104 range, to say, okay, I'll day trade some of this, but I'll also put part of my account, part of my equity here into something that I just want these 103 halves for this week or next week or however much time.
And I don't want to say it's not more advanced. This is a challenge for new traders. They tend to do all or nothing. I'm long, and I either got to get out of all of them, ideally for a profit, or when I get squeezed out, I get out of all of them. Incrementally, you could trade FX so small, down to a micro lot. 0.01 of a euro, I think he has around $25 of buying power, margin requirement. Now, that's just the function of leverage. And again, you can lose more than you put in. But if you're trading a couple of those micro lots and you're long, it's not a binary decision. You can manage a portion of that with the idea like, I'm going to stay mechanical around the one standard deviation day trading scalping, but I want to keep a small portion a little bit longer. There's nothing wrong with that. Just make those decisions ahead of time. Yeah. Go into what your game plan is. And taking, just from experience, when you bought the 104s, they seemed so cheap at that point until they weren't. And they're going down through 90, through 85, through 80, pretty darn fast. Managing part of that, if that happens to be the stone cold load and they bounce, you still have some inventory. If they continue to go, those sales that seemed selling them at the bottom weren't the bottom. So thinking about what you want to do, if that you're playing that, boy, this is cheap, and you want to hold on to a portion of that, think about that beforehand. You've got to have your strategy and your scenarios in place. And managing part of the position, there's nothing wrong with doing that. What you're going to find is if you manage part of it and they continue to fall, you're going to be, thank God, and you're going to stay a little bit more mechanical with them. And if they bounce, that's a good thing because you still have some longs. So think about if you are, and it doesn't make it more complex. It just gives you more flexibility around sizing and what your objectives are. You don't have to have just one objective.
Sure. And yeah, I mean, I can remember, it's funny, yesterday's Fed event reminded me so much of the worst Fed event in my trading career when I was at the Board of Trade, which was like, I just had the worst mindset ever. I'd come off of, you remember that period where like we would have weeks of interest rates when they were at zero, right, and they were thinking about like the first hike, and they kept pushing it off, and we would have weeks and weeks and weeks of no action. Right. And so heading into this event, I'm a young trader at a prop firm, and the older guys are like, well, you need to, tighten up. If the market is tightening up, then you need to be a little bit more aggressive and get in there. And I'm like this 22-year-old kid, I don't want to lose all your money, when in retrospect, it wasn't my money to lose. So maybe I should have been more aggressive. But that's neither here nor there.
I wish I had you on my desk at that time.
But going into the event, I'm like, I've got it in my head. I'm like, okay, these guys want me to be more aggressive. I got to be more aggressive, whatever. And of course, it's the one event. They're not expected to hike or do anything. They don't do anything. But then the rhetoric afterwards is like, we're definitely going to hike next meeting. And the market just blew out. Right. All of the spreads that I'm trading, knob spreads and tut spreads and tufts and fights and everything. Yeah. And I'm immediately through my limits on everything. And this kind of thing happens where I'm like, okay, I've got orders. I'm getting filled here, here, here. And then here, I'm like full boat. Right. And it's got to come back or Gene is going to be tapping me on the shoulder. And he was a couple minutes later. And then it keeps going. And then, inevitably, again, I don't want to make it seem like this always happens because, of course, theoretically, a market like this can go from 105 to 104 to 103 to zero if it wants to. But the way that markets, especially big liquid markets like this, are structured, there's usually a point where they pushed it too far and then it comes back a little bit. Yesterday it was 103.5, and there were plenty of guys at my prop firm that didn't have my mindset. That got some in here that weren't great, got some in here, and then we're able to have a pretty good cost basis and wade through it
and farm a little of them out.
But again, whether it's you're at a professional firm or you've got just a retail forex account or whatever your setting is, if you've got, let's say, $10,000, you don't have to throw it all at one shot. Here, you don't even have to, in a huge move like yesterday, standard deviation move, you don't need to go full boat at any point.
Right. If you can get small enough, which is one of the great things with SpotFX, you can get really small, you can get incremental. And so you can dip and dip and dip without, you're not trapped in institutionally sized products.
Sure.
That, okay, if I've got two on, I'm uncomfortable. So that is really a powerful
And I didn't have
piece.
that at the
you were trading institutional products. It had big.
I was like, I've got like
all
20, 10 years and like 5 ZBs, and I am tracked.
That's a lot. And and all the mechanics go out the window. And let's not kid ourselves. And this is an important part for traders. You're going to take losses, and some of the most successful firms in the world work on a basis of 52% wins, 48% losses. And they trade enough that that's a very lucrative endeavor. Yeah. So the idea that we're not going to take losses is, and again, this risk-taking behavior is against human nature. We're not risk-taking. We're not built as risk. Well, you are. I mean, you went to Michigan. You have to take risk when you go to University of Michigan. I mean,
to survive, yeah.
Yeah, the possums, the squirrels, they'll kill you. You have to take. So as risk takers, we have to be mindful. Yeah, we're going to be wrong, and we're going to take risks. We don't want those risks to consume both our ability to be mechanical and to come back and be a participant on an ongoing basis. So keeping that in mind, that taking losses is part of, there is no magic carpet that only gives you win. Taking losses is part of the dynamic. How we do that and manage those strategically, how we think about them with the addition of statistics and math and the power that brings to it, those are all important ways for us to take that 50-50 and turn it into a favorable outcome. So this was a great example of that. But so today we've got a bounce back in everything. So if you wanted to sell them, you're getting a bounce.
Everything
now,
but
yeah, right. Well, and last night the BOJ came out. It's the one time they actually came out exactly on time. They were supposed to come out at 9 o'clock at night. They came out at 9:03.
That's no good.
They
came out on time. That's no good for yen.
I know. And I came out. I actually went to bed because I'm like, I know these knuckleheads won't come out till 11:30 or whatever. And I woke up this morning at 9:03 they came out and they said they're not hiking rates.
Not inclined to hike.
Yeah, and left a very terse statement after
157.
That. Right.
Holy smokes.
So.
But yeah, give back across the board.
Yen taking a drubbing, so the crosses are really blowing out here. Euro yen, Aussie yen, the usual suspects.
Well, yeah, today's especially bad for these because you're getting the euro bounce and the yen weakness.
Exactly.
But yeah, I mean, even dollar CAD, a nice reversal here. That's again would have been a nice trade if you didn't go full boat into that first move.
So this looks like okay. Buy the rumor, sell the fact. We got the fact of the rate hike. Canada has been on an absolute tear from 136 to 142. What do you need to see as a trader to say that they squeezed out all the dollar Canada shorts? They got some guys long at bad levels. Maybe there's more legs to the downside of this correct. Because when you look at the daily, it's like, yeah, we're not off that much.
Yeah.
What do you need to see from kind of a structural standpoint? You need to see us get back down to those starting levels that we were at 1 o'clock in the afternoon before the Fed announcement to say that maybe the longs are finally trapped a little bit here.
If you're saying by the end of the week, then yeah, I would say like 143 here or like 104 half in the year, like pretty much where they went into the meeting.
Right.
Would be somewhere where I would have to feel some confidence. Because they can, this is the weekly chart here. They can, of course, take this dollar CAD market up to 145 or or beyond. They have in recent history. Have they spent a lot of time up there? No, but like we just talked about, these moves can be so violent in leveraged markets like this that it doesn't have to stick around there longer than a handful of days. But yeah, to feel some confidence here, I would have to, and let's go back to that 15-minute chart really quick just to show people. I would want to be, closer to 143 here where they were before that number to feel some kind of longer-term confidence that this was reverting.
Right.
This was the blow-off top.
This may have been the blow-off top, and that's kind of what we're looking for in terms of tradable opportunity. The yen, you want to sell dollar yen? It's expensive.
All you want.
But it's not showing you, again, the congestion we're seeing. And go back to the shorter-term chart,
sure,
because structurally that looks horrible.
Brutal.
But the short one, all we're seeing is, again, that's congestion sitting right at those tops. So I can't get excited about selling this. Is it expensive versus yesterday? Absolutely. Versus a month ago? Hugely so. But I from my standpoint, if you want to dip a toe, you dip a small one. And you're mindful of, again, the question is, when you look at that, where am I getting out? 160? If you're going to sit in for it that long, trade the appropriate size that it doesn't put a lot of pain in you. Size that down a little bit. Or be mindful that in terms of what I like to do is I like to look at, okay, I'm looking for a two-handle pullback to 155. But if I'm wrong, where am I getting out? And this doesn't, you just have to pick a spot because there's nothing back on the chart that gives you any kind of semblance of 157.5, 157.70. That's all just noise.
We've seen the big moves and then the drift.
Right.
And so you have to make it price-based, not like time-based of like, oh, I'm going to get in here and I'm going to get this reversion today or tomorrow.
I'd look at the crosses. I'd actually, in this instance, I'd be more interested in euro yen than just trying the yen top.
Yeah.
Because it's giving you a little bit bigger extreme on the very short term. It's a little bit more interesting to me. But let's wrap it up there.